Well, after some incredible gains in global equity markets from the April lows, 33% in the case of the NASDAQ, we ask, are markets now priced to perfection, and where the risk to reward could be sitting and residing in this situation? What is the catalyst to drive us in either direction? Is this the time to get a little bit more defensive? Increase hedges in certain situations. It's very cheap to do so at the moment. And we ask where the direction of play is for the US dollar, for crypto, for the euro, for gold, and a lot of other markets as well. And we look at what the trade is in this crazy world of markets. This is the trade off. Well, hi, I'm Chris Weston, Head of Research here at Pepperstone. I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics. And we will be, just, as always, talking about the global markets, what's going on in global markets, where the direction of travel, where we see the risk prevailing across different asset classes, and ultimately trying to make sense of this crazy world of markets. Mr. Blake Morrow, coming to the show, my good sir. We have had a very strong rally in equity markets. The US dollar seems to be consolidating at the moment. Gold's trapped in a bit of a range. Bitcoin was flirting with all-time highs yet again. But we do seem to be missing a catalyst. Are we seeing a catalyst emerge and potentially a bit of life coming back into these markets? Are you seeing it in your crystal ball or on your radar, Blake?
Crystal ball. Well, I don't have a crystal ball, but the CPI gave us a little bit of a kicker today. I think it was great because markets were expecting a hotter number. We got a weaker number. What's interesting, though, is the equity markets didn't respond the way you would think they'd respond. Currencies did. The dollar did what it should have done, but the rest of the market didn't, Chris. So do we have some catalysts? I think we have some. I think we have some push and pull and events globally that are shaking the markets a little bit and kind of confusing. Everything from the riots in Los Angeles and the LA area coming under riot patrol, if you will, and to the Iranian threats that we're seeing that's launched crude oil. So I think there's a lot of cross market currents right now that are moving. So is there any major catalyst? I kind of sniff one coming out, though.
I can sniff one out, and I'm going to tell you what it is. Let's go into topical thunder and discuss it in a bit more depth. Okay. Look, equity markets. I think we've seen an all-time high. We've seen an all-time highs recently in some of the European equity markets. We've seen a little bit of weakness coming through there. Maybe they're leading the charge. We saw the Australian equity market, the ASX 200, hitting a new all-time high yesterday. We got the Nasdaq and the S&P not a million miles away from those all-time highs. And I think some of the gains that we've been seeing from the April lows have been pretty staggering. I mean, we're up over 30% from the April lows in the Nasdaq. S&P is a little bit lower. The Hang Seng, while still quite some way away from the all-time highs that we printed back in 2018, have rallied about 26% from the lows. Kospi, similar sort of numbers. Japan's well off the lows in those sort of regards. And you've seen a really strong bid up in small caps now as well. So the question is for me, is have we got further juice to go? Can we make all-time highs in the Nasdaq? We're so close. Or are we now priced to perfection, so much so that any bad news is going to resonate a lot more than further good news around tariffs, trade, whatever it's going to be? So where are you seeing the risks now for a lot of these global equity indices?
Well, so you talked about tariffs and you talked about like the positive headlines that we've seen come out of China. That's good. Should have been a catalyst that's driven us to maybe all-time highs in the U.S. equity markets. Non-farm payroll last week on Friday. Good number. It was a solid number, actually. Inflation data came down. And the market should enjoy the idea that the Fed probably has more leeway in cutting. And the market hasn't rallied. So when you start looking at some of the positive that we've seen over the last week, since the last time you and I met, you would think that the equity markets would be higher. And because they're not, does make me skeptical that we're probably running to your point, or to use your words, the market might be priced to perfection. So that's kind of how I'm seeing it. And does that mean you need to run out and just start shorting equities right now, or getting short? I don't know. I think we might be a little early there, but because you think about it, Chris, there's still a lot of money on the sidelines. There's a lot of traders and a lot of investors that are not involved in this squeeze that we're seeing. But one of the things that I've learned over the years, and you could probably echo these sentiments, is that the most nastiest bear market rallies are the ones that are very convincing, and this has been a pretty convincing one.
I'm
So
convinced. I'm convinced. I mean, we do need to be open-minded, in my opinion, that these markets could kick to new all-time highs. But I
sure.
think, obviously the risk. Obviously, I'm not going to say anything which is particularly controversial by saying this, but obviously the risk of, the reward of chasing markets now is obviously a lot less compelling than it was 10% below. But obviously life looked very different 10% lower. So no, I mean, I think there's been a lot of good things. Earnings versus downgrades. Earnings upgrades have been more prevalent than downgrades. The resilient US economy, global economy has been more resilient. Trump's obviously, um, been dictated to by the markets. But one thing I want to say just on this point is, we have seen headlines just coming out from Trump talking about, he's going to set tariff rates over the next 2 weeks, and that countries can take it or leave it. And markets have responded. We've seen a little bit of dollar selling on those comments, and it makes me think the guardrail for Trump is twofold. One is the markets themselves, and the second is the midterm elections next year. With equity markets so close to all-time highs, volatility low, bond volatility has subsided. Does this now give Trump license to go more aggressive with these countries? We know he's very sensitive to market dynamics, but with the markets at these highs, does that give him a little bit more leeway just to say, what, I've got some room to play with. I can be a bit more aggressive with my tariffs. And does that mean now that we start thinking about buying volatility, looking to hedge some of these gains that we've seen? A lot of people are making some tidy profits. And does that give you a little bit of rope to take the bid out of the market and potentially equities just grind a little bit lower on the back of that?
Chris, I agree with you. And the thing is if we've learned anything with Donald Trump, he is very market sensitive. Let's call it that way. And I think you make a great point that maybe this is the time. You saw the headlines just moments ago that you were tweeting about him. He's going to set unilateral tariff rates within 2 weeks. I mean, he's saying that stuff because equity markets are at all-time highs. He has the power right now in his mind with stocks where they're at. There's some downside that could be had, and it's not going to really affect. He's not going to get the phone calls that he was getting when we were down 20%.
That's right.
Yeah.
I think you might say, I mean, I'm not telling people out there to go and start hedging and looking to, but I think, if you look at 1 month put volatility on the S&P at the moment, it's trading at 17%. It's below the 12-month average. It's not expensive for funds now to hedge. It's been it's been costly for people to hedge because the market's been ripping, right? You've seen NVIDIA really leading. Microsoft all-time highs. The Mag 7 plays have done well. We've seen a nice rally off the lows in Tesla, and people have made some profits. You don't want to be hedged in that situation because it subtracts from your alpha. Now you say to yourself, we've done pretty well. The risk reward is probably shifting, and we need to move on. But with volatility low and the cost to hedge low, people might start looking at it a little bit more in earnest. That's something I'm saying right now.
I think that's a great point. Well, I know we need to move along, and let's talk about the dollar, and let's talk about the dollar's inability to actually rally. And it can't rally, and it's kind of amazing. And I don't want to get in front of it. A lot of people are thinking, well, maybe we're getting close to levels that we need to buy dollars. And I actually put up a blog post today, Chris, about the euro dollar, about a key level at 116.50, which it's been critical since 2005. If you go back and look in history, 2005, you can go take somewhere around there, 116.50, give or take 100 pips. Yeah, we're probably getting to some levels we need to be concerned with, but that's still another 150, 200 pips away from where the euro dollar is trading right now. And I mean, the euro is closing at 115 or above 115 at the time of recording. And it looks really weak on the heels of weaker CPI. Now, the market was in the dollar's defense, the market was looking for a hotter number. We got a weaker number across the board. the dollar was sold appropriately. But as this tariff news comes along, and we have that maybe risks that Donald Trump's going to up the ante a little bit, is the dollar susceptible to more losses? And the 1-2 punch being tomorrow, where we could have producer prices actually really, the market could be focusing on that, because if the PPI comes in a little weaker than expected, could the dollar get the second punch? What are your thoughts about the dollar and where we're at right now?
Well, I think you make a good point. We talk about this idea about buying the dips in equity markets, and obviously that's been a fantastic trade for a lot of people. I think that the equity market thing is just really, you just wait for a down day, and then you buy the close on the, and you make money the next day. I think it's probably the best year in history that we've seen that trade take place. But from a dollar perspective, the trade is to sell rallies, and those rallies, like you say, it just can't get a wriggle on, and everyone's just jumping on it whatever they can get. I mean, the case. Yeah, you talk about being selective. Euro dollar above 115 now. What we're talking, the recent highs intraday, 115.73, around that sort of area.
Yeah.
I think we probably get there at the moment, because it's just grinding higher. And FX vol is low across the G10 pairs at the moment. We're generally below the 20, 30 percentile across all pairs, and that's leading me into the trade right now, which is, for me, like, you can go. People are short dollar Brazil, dollar Mex. Like the carry trades are working well, using dollars as funder. Even though you've got high relative rates in the US, you've got much higher real rates in LATAM, and that's working well. Dollar Brazil was really weak at the moment, and we continue to stay short in that pair. But yeah, euro dollar's working nicely, and I think we continue to grind a little bit higher in this momentum move that we've been seeing. So I think if this tariff news story does get a wriggle on, if Trump was to say, we've got a little bit of scope here to go a little bit harder, maybe on Europe, but certainly what we're seeing in the China situation, which we can discuss in a moment, if he's to play a bit more heavy-handed, feeling he's got a bit more leveraged, and the market, does see that as a bit of a negative situation as we go into the Senate debate on the big beautiful bill. Again, it just reinforces this idea that people want to sort of hedge out some of that US dollar exposure and that US exposure risk. So, yeah, I feel like the market is telling you that they just don't want the US dollar to rally. So, I still feel that, even though I'm not, I don't go out and say that the euro is the best currency in the world. I feel euro dollar goes to test those highs in the short term.
Yeah,
Yeah.
it's so weak, Chris, so weak.
It's just, it can't find a friend. No, everyone's just selling rallies into it, and then that's been a very clear trade. Dollar Swiss looking low. I mean, I think dollar yen is also the trade. We're testing 144 at the moment. I think we break that. If we were to see some of this geopolitical risk kick up a little bit, and that's something we can discuss in a second. The yen's looking good. Swiss franc's probably good. So I think dollar yen shorts are good. Dollar Swiss francs shorts are good. Let's see what happens there as well. And I want to discuss that situation on commodities, because the move that we've seen overnight in crude, in your time in crude, has been quite powerful. There's a lot of headlines around directive to move non-essential personnel and certainly diplomatic personnel out of Iraq, and there's talk of other states as well. We don't exactly know. I'm been privy to, in terms of the news, as to exactly what the situation is and why they're doing that. But obviously, markets are something, selling first and asking questions later as to exactly what this means. Are we looking for something that involves Iran, potentially, concerns of supply issues? Obviously that's a big issue that's been impacting the crude price, and by extension, you're seeing a few gold buyers. Recently you've seen a big move up in silver and platinum, but that's very much a China import affair. How are you seeing the commodity trade? And I want to specifically touch base on this moving crude, because it's getting quite a bit of attention. What are you seeing in terms of the news flow, and do you feel you've got more upside in the crude market here?
Well, obviously, Iran's a bit of a risk, but the thing is about crude, and we've been talking about it a lot on our daily shows, and I actually even highlighted in the week ahead video, is there, you can't find a crude bull anywhere. And so when you get in a situation like that, and everybody's like, oh, OPEC, they're just just piling on the output, and they're just going to put all U.S. refiners out of business, blah, 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 blah. You got everybody literally one-sided in the market. Then, obviously you break break above 65 bucks and wham, bam, thank you very much. You got a nice little squeeze. And we're going to talk about the technicals and where crude can go a little bit later. So make sure you stick around for that. But, you're talking energy. But, man, there's certain pockets of the commodities market that are really ripping. I mean, you look at lean hogs, go take a look at live cattle, all the proteins out there. I mean, shoot, those markets have been flying. There are some commodity markets that are really perking up in this environment, which is not going to be good for consumers in this environment. I'm not talking just for the US, I'm talking globally as well. I mean, coffee prices have gone absolutely bonkers over the last year. So yeah, I mean, crude looks dangerous. And there's a fine line, and I don't know where it's at. And I think it's probably more if crude gets above 80, but there is a line where once you start seeing crude prices go up too far, then it becomes more of a negative, and people start going, oh my God, the higher it goes, it starts to weigh on risk. And I don't know if we're there yet. I think we still got some distance to go, but man,
I've just had to go and pull up a chart of lean hogs. I don't know if we can put this up for people out there in post, but it has absolutely, because I love agricultural commodities, soft commodities, and because for someone who likes buying things that are strong or selling things that are weak and hoping they continue in that direction, these markets do have a strong propensity to trend. And that's exactly what you're seeing with lean hogs. So you do pay a wider spread for it, but you do get the movement that compensates you for that. So yeah, lean hogs has been a breathtaking trial. I was trying to think of a pun, but it's been a good one. I think it feels like it's probably done now. I wouldn't necessarily be shorting it, but that's one which could roll over and may see a bit of mean reversion play through. But
yeah, if you're buying it now, you might not bring home the bacon.
Yeah, good one.
I'll show myself out now. All right.
Yeah, I mean, I think the thing with crude, just going back to that one as well, is that we do have there is a sort of a tendency when we get into above 65 bucks in Brent, 70 bucks in WTI, that Trump starts talking about it again, and he's a sort of a natural handbrake on the price. So we've seen things like the Baker Hughes rigs count coming down, and obviously positioning, as you talk about, coming up, and now we've got the geopolitical mix in the mix. But yeah, one suspects that if it'd be interesting now if we've had this rally, price looks strong. If Trump starts to stand in front of that, I know he's just headed off to Les Mis with his beautiful wife, but if he comes out and starts talking about the crude price, which he typically does when prices move like this, that could be something interesting there as well. But I feel like there's 70 bucks in WTI is probably the next stop to go. Anyway, let's move on. I'll let you hand this over and you can chuck it over to me.
Yeah, well, let's talk a little. Yeah, let's talk a little bit about this whole China-U.S. Trade talks that were actually on, rare earth minerals. And it's so interesting, Chris. I was listening to an analyst earlier today. Is like he was making a point that if you could go around the street and talk to a lot of analysts at banks and ask them, like, where do we stand with China and what are the tariff rates that we're looking at? And he argued that no one knows. And
no one knows.
No one knows. And what's really interesting is you saw the market getting so excited about these rare earth, tariff negotiations that have been happening in London. And, the deal's done. The market responds. You get people on X that just are like, China-U.S. trade deal is done. And then you have actual news agencies that report, oh, there's a deal that's done. And then you have mouthpieces like, Howard Lutnick, and then you got to listen to Bessent, the Treasury Secretary, and the Treasury Secretary says we have so much further to go, with China, and everybody goes, oh, wait a second, oh, so we're not actually talking about the trade deal, we're only talking about tariffs. Okay, so maybe the deal's not done. Anyway, it's so confusing out there, Chris. I'm not going to sit here and put you on the spot and try to get some clarity because I don't think there is any. But the fact of the matter is we still have, as Bessent said, Treasury Secretary Bessent, there's still a lot of work to do with China. So if you're going to sit here and look at the markets and think that there is some China-U.S. is done, I think you're misguided. And I did try to post something yesterday on X or on Twitter that it's like, guys, this is just rare earth minerals. And does it do a little bit for the China-U.S. relationship? Sure. Is it the end all be all? Like we can walk away and high five and say everything's good? No, we have a lot of work to do here. So
Yeah.
how are you seeing the U.S. China trade situation right
Oh,
now?
I think the market is just, as long as they're making constructive dialogue, that's probably enough to keep being at risk, and we can just sort of go away from the maths. But the maths will matter. But what did I see? We saw a headline saying from Trump saying we are getting a total of 55%. China is getting 10%. China getting a great deal. Then you see headlines saying Trump to hold new tariffs at 30%, 10% baseline, 20% fentanyl. The effective tariff rate is going to be on China will be 55%. And you're like, I don't really understand all this maths, to be honest. If you're comparing China at 55% and Trump saying we got the US on 10% tariffs, so China's taking the mick a little bit, and then you see this effective tariff rate's going to be 55%. But I was looking at one US investment bank, it's Morgan Stanley, who said that their calculations at the moment sees the effective tariff rate on Chinese imports at 38%. So again, like the market is seeing all these different numbers flying around. I think, at a simplistic level, unless you're an importer from China and you're trying to actually work out what tariff rates effectively affect you, for most market participants, you're probably saying as long as the dialogue is constructive and they're making the right noises at the table, then we're happy to continue bidding up risk. But things could get a little bit more spicy. I do think one of the big things about the deal, what we've been seeing, the framework, is that the US are going to be getting the rare earths, which is so essential for defense, for autos, for renewables, all these factors. And it makes it look like the US have got a really good deal, because it doesn't look like they're relaxing any export controls on chips to China, and that was considered to be a big deal. So you're trying to work out why the Chinese would have allowed the rare earths, because that's their play of leverage, when they're not going to be getting any of these chips that they need, and that's really a big story for me, is the rise of China as a dominant AI player, and they want to be the leader in AI by 2030, and they're going about it in exactly the right way to be the leader in AI going forward. So the failure to get these chips does dent that a little bit, but why then giving them their rare earth? So there's a lot of conjecture for me, as I say. I think the market will tell you when it becomes a bigger deal. At the moment, as long as they're at the table making the right noises of togetherness, then I think the people will be buying dips. But it's a bit of a weird one, to be honest.
It is so weird. Can we go back to like, can't somebody just give me a poster board like we got on Liberation Day, and somebody just give me a number? I mean, I could trade on
That's right.
that.
Yeah, we're gonna know apparently in the next 2 weeks about all these unilateral rates and bits and pieces. So hopefully the coast will be clear and we can tell everyone exactly what the effective tariff rates on each country is going to be. We shall see, but that could be a date for the diary. Anyway, let's go to that setup. Rightio, let's go to gold, because it is stuck between a bit of a range, and this is one that I talked about last week. You can see that the black horizontal lines. We have a bit of a range of about $100, which we've got a range within a range. I think that we do go on to test those recent highs. I think again, China's sort of taken its foot off the ball a little bit. You haven't really seen the flows in ETFs in China, and Shanghai futures has been a bit lackluster, and there has been a lot of focus on what's going on in platinum and silver, where the import numbers in China have been very, very strong recently. Lease rates have been very high, which means people, the cost to borrow it in the market, cost to borrow. The warrants in the market is obviously high, and that shows a very tight market indeed. And so that's been a lot of, but we have seen some of the pressure coming off silver and platinum and palladium, and maybe some of the focus and the flow in China can go back into the gold market in the short term. Obviously, I think you're probably going to see the crude price dictating a little bit of what's happening in gold. If gold does become more of a sort of a safe haven play, then obviously if we were to see further highs coming through in crude, obviously that's a big if. I'm not an expert in what's going on, but we are keeping an eye on what's happening in the Middle East and some of the news flow around that. And if crude is to respond and push higher, then I'd imagine we're going to get a breakout through that initial recent high, and then obviously we go into to test the big double top that was in place. So that's something I'm watching there as well. But price will tell you exactly what you need to know, and that's the thing with gold. We always know what happens after the fact, and everyone tries to pick a reason of it. That's why I look at price above anything else in gold. It's the only fundamental I need to know. But if crude price does kick a little bit further higher because of this geopolitical news, I'd imagine, and especially if the dollar weakens because of what's been going on the trade side, the gold upside is there for the taking.
All right, Chris. Well, gold, I tell you, consolidating at the highs is not bearish to me.
No.
That's all I have to say about that. Speaking of crude, let's talk about it. And the crude market is my first setup, and you'll notice, and actually right now as the market opened, because this image was taken before they reopened the market. We're at the 200 DMA right now, and we're just above the 127% extension at 68.25. And this is the Pepperstone CFD, by the way, is what we're looking at currently. Now, I expect, and you can see that shaded area at the 161% extension, that comes in at 71.67. That is the level that ultimately, you try to project on, a key golden Fibonacci level like that, an extension, given the fact that we've squeezed so hard today. And I always go by a simple rule of thumb. If there's a big green bar or big white bar, if you're looking black and white, big green bar is usually followed by another big green bar, usually. So the next phase of this rally might take us up to that 161% extension. The reason why I say this is a setup, because if you guys are bearish and you think that we're going in a recession or whatever the case may be, and your base case is crude goes down, well, maybe that's the level that you want to be on the short side. But until then, for those of us that are looking at the long side, it looks like we've got a couple more bucks left in us, Chris.
Yeah, cool. Well, I want to switch focus over to the US 2000, or that's the name for what we call it, is the Russell 2000. It's the small cap index of the US. Now, that index has had a remarkable rally, like everything else, to be fair. But what I think is we are still well away from the highs. But look at the pattern we've got. We've got an inverse head and shoulders pattern extension, but now we put in the big candle reversal pattern of through that neckline. So what do we want to see? We want to see this come back down to test the neckline at 2109. Look to reject and then kick up. That would be interesting, because obviously if we were to see S&P futures or S&P NASDAQ, some of these European markets coming under pressure because people see the risk reward, there's no way that you're going to see the Russell continue to trend higher when these markets are going down. You're just not going to see that happen. They're all going to move, but just at different beats, different speeds. But this technical setup is there for the looking, because we have seen an outperformance from small caps, which goes to perhaps show that we are in the late cycle of this rally, that the laggards, the things that didn't initially take part and perform well at the beginning, are now playing catch up. This market is still well off the highs that we saw within the 12-month highs, and the laggards are starting to close the gap a little bit. But this technical setup, given that's what it is, we have a big inverse head and shoulders. We've broken the neckline. Do we go back to test the neckline and reject it? It's obviously going to be dictated by global markets. Or do we see that failed breakout to the downside, in which case, I'd be looking to potentially go short some of these small caps. But it is very telling that we have seen outperformance at this stage in the cycle in equity markets in the laggards, and that may tell us that we are running out of a bit of juice. It's something I'm watching closely.
That's a really, really interesting chart, Chris. Thank you very much for bringing that up. All right, my last chart is going to be the Swedish krona, the US dollar Swedish krona, and yes, we're SEKing alpha. But get it? I thought I was being cute. I thought it was cute. Anyway, what you'll notice here is the US dollar Swedish krona is actually consolidating right above its trend lows, which is the 127% extension around 950. Well, it's at 954 right now. But 945 is the low. And so you start breaking below that level, we're going to be targeting 902, or basically 9, the big figure. This is a perfect example. And this is actually of the dollar index, the Swedish krona has a pretty sizable chunk of weight to the dollar index. But this is a really great example of a dollar of the dollar just not being able to rally, not able to muster a rally. And when you're consolidating at these lows, you see how that relative strength is actually moderated back to basically break even, or I'd like to say it's moderated back to neutral. Now I'm looking for a breakdown of price, but also a breakdown of the relative strength. So if you see price move below that triangle, you see relative strength break down. That is a confirmation to me, in the most basic form, that we're going to see a resumption of downward trend in the dollar. So US dollar Swedish krona, as we're SEKing alpha.
Yeah, I mean, the stock has been such a performer this year for a number of different factors, but it is kind of like your risk beacon, and the euro typically does like to follow it because, yeah, the economies are so closely interlinked. But yeah, an interesting one there as well. All right, let's go to play of the day. Right, I'm going to go for the German DAX because for people out there who are looking at the first mover in the index side of things after substantial moves that we've seen from the April lows, obviously a lot of short covering coming through in the early throws, but then, as the situation, other flows have taken place, a lot of passive, a lot of CTAs, a lot of ETF rebalancing have pushed us up higher, people chasing the market. But then the cyclicals kicked in. The cyclicals started outperforming defensive as we saw a more resilient US economy and global economy playing through. Obviously, the tariff news flows has perpetuated that move. But we're expensive now, and a lot of these global indices, the risk reward is pricing in a lot of good news to take place. A lot needs to go right to keep pushing these markets higher. The DAX was the first market into all-time highs. It led us higher. Are we going to see this as now the canary in the coal mine to lead us lower? We've seen three candles lower. I like this short here. It's aggressive because obviously we're not so far away from all-time highs, but momentum has shifted. We're seeing the rate of change going to the downside. Yes, stochastic momentum has moved to the downside. We obviously know where we can put our stop loss on this situation. So, I'm short on this pair on this index right now in small size. If this starts to move a little bit lower, I know people are still looking to buy the dips, and I agree with that. But I think as a trade, I think there's further downside in this market. Maybe play this like short DAX, long Hang Seng, long Nasdaq, or you want to play it really defensive, short DAX, long ASX 200 because that's a more defensive value market, slower beta. Obviously, you need to think about that in terms of the weightings. But I think this is the market now that's showing its hand. If you like selling weak, which I do, then this is probably one of the weaker after a period of massive strength and outperformance. This looks like it may be subject to the more sort of profit taking, and I think this has probably got a bit downside risk in the short term. So that's the direction I'm headed.
Well, for all the old school, long-time listeners, 3 years or more listeners of the trade-off show, the DAX is dead. The DAX is dead.
DAX is 2% or 2% off its all-time high. You can't
The DAX is
that.
going to die. It's going to die.
It just needs a little bit of resuscitation. That's all. But yeah, I think this is just an aggressive short. I'm not giving up on the DAX. I think it's all-time highs for a reason. It's just I think there's just a bit of a tactical downside in coming through.
Good point. Good point. Okay. Nice, Chris. All right. So mine for the glass is half full crowd, people that like risk and think that, hey, we are going to challenge all-time highs. I'm going to give you the Euro Swiss. We just broke out of this triangle, and I do not own the Euro Swiss right at this moment. I am going to try to buy dips. I got some orders to get long overnight, actually, as I'm in probably fast asleep around the 94 cent level. But we broke out of this base. I do want to add on a break above the 50% retracement, which comes in around 94.40, 94.45, right around there. If I can get long a little bit here and get a break above 94.45, I'm going to look for it to extend itself. The one thing that the Euro Swiss has going for it is, to be frank, the euro. The euro is underloved pretty much globally. Everybody hates the euro. That's why I like the euro. I'm more of the, people are trying to find different places for their once held dollars. I think they're going to be seeing it in the euro, as long as we don't get too much risk off. If there's risk off, then this trade's naturally not going to work out. It tends to trade heavy when risk trades heavy. However, if you are a glass half full guy or gal, I like it. I like it to the upside. And we just cleared the 200 DMA, and I'm looking to buy dips now.
I want to just we go back to our US dollar thing. When you talk about the euro being unloved, I think the US dollar is so underloved that every strategist now is bearish on the US dollar. I mean, Morgan Stanley looking for euro dollar to get 125, JP Morgan bearish the dollar, Goldman Sachs bearish the dollar. Are we at that point where they're just, could we see that being that in itself, the contrarian play when everyone's on the same side of the ship? It's really hard to find a US dollar bull out there. So
it is, but remember, the dollar has been such the dominant story for so many years, Chris. I just think that let's revisit this if the euro gets to 120. Then I think we should.
The thing for me, which I think is really interesting, is when we talk about flows and the players in the FX market. it's the hedge funds who start this gangster shit, right? They're the ones who start the move, but they're not the ones who necessarily keep the move going. It's when the real money players come to work, the insurance companies, the pension funds, the life companies, they're the ones that move the market because they're slow, but when they go, they just set off a trend and the hedge funds then follow. So the hedge funds like to believe that they're the ones who start all the moves, and they typically do. They're first to the market. There's specky accounts, they're leverage. But it's really when the life and the pension funds and the real money accounts get going and the corporates start going, that's when the move really starts happening. And so I don't think that's necessarily fully happened in the US dollar. I think everyone's talking about it. It's over talked, but I don't think it's over traded at the moment.
Good, great point, Chris.
Anyway,
And
I'm going to cut it
yeah,
there. Blake, very, very good to speak to you again, as always, on this Thursday morning for us, for Wednesday night for you. And for everyone at home, we really appreciate you sticking around. Thank you very much. I hope you enjoyed the show. Click the like button and smash the subscribe. And we'll see you next week for more of the trade-off.